I'm Keith McCullough, and welcome to The Pitch. I love The Pitch. They got 10 analysts on this show now. They're just jamming me with this stuff into quad 4. I'm sure all my analysts are going to be bullish with longs. Not. Howard, let's start with you. I think the new rule is 4 minutes, and then you get the buzzer.
Bullish with a long, Keith.
No.
Totally.
Yeah?
Yes.
Okay.
I got a stock, what do you call it, that is for all quads, I guess. I don't know. But anyway, I got 4 minutes and I'm wasting time. Domino's long, Keith. Buying into the concerns that they're out there for Domino's today. I think I understand what the concerns are, but never in the history that this company's been traded publicly, I think there has been this much controversy. So I like buying into names that are controversial, have underperformed. It has a unique value proposition in this market. You can mix and match and walk out with the Domino's for $7. So it's a great value proposition. And also, you have, the valuation and performance sort of reflect the negative. The street is negative. Let me run through all that. So on slide 5, you can see 3 years of outperformance have come under pressure in the last year. So it's underperformed the S&P by 20% this year. It's down 40%. So again, buying into the controversy. As I said on slide 6, it's a stock for all quads. It does best in quad 1 and quad 2, but it still does well in quad 4. But I think I understand why it is underperformed in quad 4. So this is, like I said, it's a stock for all quads. More importantly, as I said, the value proposition is important for Domino's today. Consumers are searching for even more budget dining and grocery options. As you can see on slide 7, this is a Yelp data surveys. No surprise, right? People are in this inflationary time. People are looking for value. Domino's offers that. And what you see, Keith, on the next slide, slide 8, is a turn in the fundamentals. So this was a pandemic winner that had a hard time lapping the comps, and it was lapping the comps when it couldn't get anybody. It didn't have enough drivers to deliver the pizzas, right? So not only were they lapping difficult comps, but they didn't have drivers to deliver the pizzas. So there was demand for the pizzas, but they didn't have drivers. And that's because nobody wanted to work, frankly, coming out of the pandemic, because they were getting paid to stay at home. That condition is going to, is already starting to fix itself. As you can see in the last quarter, they went from down 5 in the U.S. to up 2, something like that, and comps are going to accelerate into the next 3 quarters and into the first quarter. So it's a pod 1 acceleration in the comp standpoint. The international business is lagging on the right side there. You can see it's also going to turn positive this quarter. It was still negative last quarter. So both domestic, international in the next 2 quarters will show positive comps. And you can begin to see that on an aggregated basis on slide 9. You can see the difficult comparisons and then the deceleration into the third quarter of this year, and now we're re-accelerating. So, but we do understand, I think I do understand why the comps did decelerate, difficult comparisons. I said driver shortage, and now we're lapping those easy comparisons, and we've got drivers back in the door. Most importantly, and this is slide 10, this is a business model that is unlike any other business model in the restaurant industry. So you can see slide 10, what you're seeing is EBIT margins, and this is really kind of a boring chart, right? Because the EBIT margins were 18.1% in the first quarter of 13, and they're 17.3% in the, or going to be 17.1 or 17.3% in the first quarter of 2023. So very stable business margins. And as you can see, as the pod 1 accelerates, and I did not include the unit growth slide in here just because I don't have enough time, but they've got 6% unit growth, 4% comps. You've got 10+% top line growth, and you can begin to see the leverage in the business model. So this is a business model that's built for a higher multiple. As long as you got the comps and the top line growth, you're going to see growth acceleration in pod 2, frankly, which we're beginning to see. Slide 11. You can see the street has gotten decidedly more negative. You were looking at 60+% longs, and now you're at 30% longs today with a few sells. So the street's very negative. As I did say before on slide 12, there was a turn in the estimates. As you can see, that now revenues and earnings are starting to be revised higher. And then from a valuation standpoint on slide 13,
right on the buzzer. And I'm just going to provide some commentary, not a question. McGough's going to be on in 2 minutes. But Domino's stock goes from 550 to 331. Risk range is 314 to 349. So you don't have a lot of downside. The volatility is coming out of it. That's what you're actually looking for in Quad 4. You're looking for low beta, which it now has. It had higher beta, and then it crashed. And by the way, Penney was bearish on it, into that crash. And finally, the stability of free cash flow and/or EBITDA is actually one of the vintage and cornerstone pieces of a portfolio in Quad 4. So this one, the point that Penney made on the stability and visibility of cash flow, what you want is that, and what you want on the other side of that is shorting anything that Brian McGough doesn't like, by the way, that has massive cyclicality to earnings. Right? We've seen some big ones. I'm sure that you're going to give me another one in terms of earnings revisions with like Sleep Number. I mean, the number, it went from $4 to $3 to $1.
It went from almost like $9 down to $6, down to $4. Look, in retail, the first miss is never the last.
Yeah.
They just keep on coming, and that's what I got here for you. I swear. Like all of my longs are shorts right now. I couldn't pitch a single long right now and be convincing about it in macro Quad 4, especially with what's coming down the pike over the next couple of quarters. Anyway, the short I got for you was Home Depot.
Nice.
Is a name where it just made it to our short list about 3 weeks ago, up to our best idea short list a week back, and then just this past weekend upped it again, and this could be my number one short over the upcoming, 3, 6, 12 months. So a couple of charts here for you. The first chart here is something I borrowed from you and Steiner, just showing what mortgage rates have done. I don't even have to go over this. I mean, they've gone up over a 3-month time period at a rate of speed that equaled the entire Great Recession. That is so bearish for housing, and it seems like people are they view this as a safety stock. Everybody owns it. No one's short it. And they think that this company can just keep on doing what it's done over the past 15 years. And I just think it's very unrealistic. If you take a look at this next chart here, and this one's important, it shows you what the company did during the GFC. This company comped down 14 quarters in a row. Margins went from 12 down to 7. Again, numbers, once they start coming down, they just keep on going and going and going. And management teams can't, even though this is a great management team, no one would ever dispute that. I would never dispute that. They know what they're doing. They're the big boy in the space. But they can't sidestep macro, especially this housing environment that we're looking into now. Next slide here just shows, again, I borrowed this from this kind of framework from you guys, Keith, on the macro team, but just showing what the stock did in the Great Recession versus other housing downturns and where we are now. And take a look at that red line. Yeah, the stock has been relatively weak. It's now a $300 stock. I don't know if I'd call that weak, but we're just at the start, and this could keep on going. And we're at elevated interest rates now for a really long time. So whereas Quad 4 might end, I hope, because then my longs start working in another 3 quarters, this could still just keep dragging down and dogging it over the course of a multi-year time period as we're just in a permanent elevated interest rate environment, if that is so the case. Next thing I want to hit on is my Sigma, which is sales inventory gross margin analysis. This is my answer to the quads, which is, this is a manifestation of the pods. Punchline is, I won't go through what the whole chart is and how to read it. You do not want to be in retail Quad 3, which is in the lower right-hand corner. That means you have too much inventory. Your gross margins are still up. Your EBIT margins are still up. So management is still hopeful. They're ordering more product because they think they'll sell it, and I don't think they will. And then lastly, I want to point to just what the earnings power of this company is. And if you look at the lower right-hand corner of this slide, I know it's a little tough to see, but we're coming out at a base case number of 1478 next year. The street's at 1735. That's a 15% move. I got to tell you, I'm not bearing up enough on those numbers. So if you give this company a down 6 comp, which it could do in a heartbeat, like no one thinks Home Depot could ever comp down. It just always comps up in every environment. If you take a look at that chart on the lower right side, it shows traffic trends. They are negative. They are squarely negative. They've been negative past 5 weeks versus 2019 have trended down. If I really stress test this model and I give them a down 6 comp, I deleverage gross margins, I deleverage SG&A, I'm coming up with a $12 earnings number. This thing will,
Wow.
and the street's at 1735. We're talking Home Depot here. That is a colossal move. There was a bulge bracket firm who came out, initiated coverage with a strong buy rating last week. Out to lunch, not going to happen. This is a $300 stock. It'll get a 12, 13 multiple on a $12 earnings number. And that's a $150 stock. So 300 to 150 for a big cap, quality, over-owned, under-shorted name like Home Depot is a massive beta adjusted short.
Yeah, you just got, you didn't hear the buzzer, but it just hit right when you did that. It's like if I go to the pre-pandemic high, like you show that stock chart again, it was 225 or thereabouts. Pre-pandemic all-time high. Home Depot's not a young company. It's an old company. It's so old I covered it like 23 years ago and modeled it. And by the way, their earnings were cyclical in 2000, 2001 during a recession. They were cyclical in 2009. But at $12, even at 225, it trades at almost 20 times earnings.
Yeah.
I mean, and everybody owns it. Yep. It's got less than 1% short interest. By the way, the risk range is 265 to 299. So, it's sitting pretty here, add to shorts. Vanguard owns 8.5% of it. It's like the most passively owned thing on the earth. Do you get, what's the passive aggressive commentary from hedge funds on this, right? Or is it like Amazon or not? Everyone was long Amazon, whether or not they acknowledge that or not.
The pushback on this one I get the most is that it's got this big pro business where if you're doing a project on your house, you go and the contractor goes and they buy the product at Home Depot, and there's this backlog. So there's this backlog of projects that'll still be going through in the first quarter of 2023. So the pushback I'm getting isn't even that, it's that this company just knows how to comp and it'll comp in perpetuity. 2, it's that there's this backlog and I don't want to short it now because I don't want to get squeezed when they're putting up positive comps in one quarter as they work through their backlog. I'll look through that in a heartbeat because numbers are going a lot lower and the multiple will go with it.
Good. Short it. All right, there we go. Ami, you're on the phone. Thank you, Brian. We're on time here. You got 4 minutes.
Hey, Keith, we are pitching short Microsoft.
Nice.
A $1.7 trillion company with a 1% dividend yield. Everybody, I think, hopefully knows the ticker on this one. And here's why we're short. Number one, Microsoft has been through cycles before, and cycles actually do hurt Microsoft. And what we noticed over the last few months was that even just suggesting that Microsoft was going to see the tide go out was such an anathema to investors that we get a hate mail on this subject and hate tweets as well. And so we were like, there's a problem here. And because Microsoft had become a place for shelter, basically for people to hide from a macroeconomic recession, which is really a bad idea in general. Now, up until through the July report, through the June quarter, Microsoft's fundamentals had gone in one direction, but the street had gone in another direction. And what we noticed was, if we go to slide 2, what we noticed was that even on that great June report, looking backwards, we saw that the incremental RPO billings growth was below their, or at the low end of their historical seasonal averages, or below their seasonal averages. And so we started to see that the actual buildup of excess was now starting to ebb out, even if it hadn't started to impact numbers yet. And if we go to slide 3, the second thing we saw was that we're looking across, the holiest cow at Microsoft is Azure, and that's the growth rate that everyone cares about the most, because it basically, like, if you look at their how they disclose revenue growth and all their constant currency numbers and everything, it populates, it's behind like 4 of them or 5 of them different areas is Azure growth, basically. So it's like the centerpiece of the growth profile here for the company. And what we had noticed was that Microsoft doesn't disclose very much on Azure, but when we look at leader AWS, what we saw was the left-hand side here was the chart, the duration blowing out of their backlog, which we've seen, which means, in fairness, it means that companies are signing up for longer and longer contracts with AWS, but it also means that the growth of that backlog won't the near-term growth of annual contract value, or translation forward revenue growth, will not marry to that backlog growth, because that backlog growth has dollars in it that stretch longer and longer and longer and create uncertainty around the duration of when those things actually hit in revenue terms. And that is exactly what began to hit Microsoft, and we just reported. Software companies, by the way, have a 3-miss cycle. So we're just through in the first cyclical miss for Microsoft, and it was just a wobble. So let's wait and see. And it was defended. So let's see what happens with the next miss. If we go to the next one, Azure, we did show the left-hand side is billings for cloud, and the right-hand side is Azure billings. We had shown them obviously before the September 22 edition, but they were already decelerating into the quarter. If you could look at the next slide, slide 5, we were also talking about how one of the analysis tools that we use is looking at accrued compensation, because you add to that as you pay bonuses for sales. Essentially, when the sales team books a deal, some of that bookings go into the sales kitty, and that happens right away during bookings. That's the very front of the train. And we saw, if you look at the year-over-year percent here term, that was already decelerating. We don't get a full disclosure here from Microsoft. This is only just the balance sheet disclosure, not the cash flow disclosure. But we saw that already decelerating the last number of quarters, which wasn't a great sign for us. We knew that this thing was going to decelerate, even though they hadn't shown it yet. So this was kind of like a lead indicator. And the last piece, puzzle piece that we had mentioned was that companies in our space that had been tweaking their headcount over the summer were also then showing up with negative surprises in backlog growth. And that is exactly what happened with Microsoft as well, that they went from in May, quote unquote, raising pay to compete for global talent to they have some partial freeze and headcount reduction, partial freezes in July, headcount reduction in August, and then a larger headcount reduction in October before they reported earnings. And that was sort of like a tell for us that there was something here. From here, you still have that second miss that's coming. That's going to be, you need to wash out everything that was impacted by digital transformation. And guess what? It's going to cause people who are long Microsoft on a secular basis to question why they're long, because they're going to say, wait a second, digital transformation is no longer the right place to be, which is true. It is no longer the right place to be. The next cycle will not be driven by digital transformation. Microsoft has some things that will benefit in the next cycle, like AI. They have some strengths there, but they also have a big portfolio of digital transformation that isn't going to get a benefit. And that's why on the next miss, people are really going to question why they own Microsoft. And this thing is going to get a lot cheaper before bulls should really even consider whether they should own it. And I'm talking about the dividend yield should be multiples of where it is now before people really take a hard look at it and say, man, this thing is too cheap. And that is a long way off.
That is tight, man. You haven't heard that anywhere on Old Wall TV, that's for sure. Everybody owns this stock. I'll just make these comments and get to Todd Jordan because we're out of time on it. But again, 1.7 trillion in market cap. Okay, the stock pre-pandemic was around 185. Okay, risk range is 219 for now on the low end to 237, but going to 185 is just taking it back. Look at all these charts. It's the mother of all bubbles post-pandemic. In case you didn't know, now you know. All right. Even Satya Nadella sells like $15 million at a clip worth of stock. Don't forget, Todd Jordan. In the words of the great Jay Van Sciver, Wall Street is in the business of selling you stock.
Well, I'm going to try to sell you one here. Don't shoot me. It's a long. So it's DraftKings, Keith, but I will qualify it by saying it's a long trade.
Okay.
All right. So this is near-term catalyst. The stock is way down. And we've been mostly negative on this one, as you know, over the last 12 to 18 months. We've got 2 separate shorts on it. Stock's at 16 now, down from the 60s. But, and yes, I mean, valuation is compressed, but it's really about the catalyst here, Keith. And, the same catalyst that really led to our short a while back seemed to be reversing here, and that's the key. So just to refresh on what was the short call, was it same store or same state betting revenues were decelerating, growth was decelerating. DraftKings was losing share, and again, this is about 12 to 18 months ago. And external marketing and promotional expenditures were set to just explode. At least that was our thesis ahead of football season last year, and it actually happened that way. So what's going on now? Well, it's really the exact opposite. And we've listed the catalysts out on slide 30, but let me run through the major ones. First, we don't have it depicted here, But same store or same state betting handle and especially net revenues are both accelerating. And I'll get into net revenues and why that's important in a minute. So that's one catalyst. Second catalyst, DraftKings has stabilized its market share, and we do a platform scorecard, which is forward-looking, and it really aims to give you a sense for how these operators are going to perform on a relative basis prospectively, right? So we're seeing that trending higher, and you can see from the right-hand side on slide 30. You can see, definitely their app downloads are trending higher, and that is a very good forward-looking indicator. That is part of our scorecard, but not all of it. On slide 31, you can see our tracker for monthly unique visitors is trending higher in Q3 and Q4, and so it's signaling a nice uptick. And also, if you look at the right-hand side of that slide, you can see that our revenue trackers are also showing the same increase, and they're very highly correlated with actual results. And the key here is that DraftKings is going to report on Friday morning. So we think you're going to see evidence of a lot of what I'm talking about on Friday morning. And then finally, in terms of the big catalysts, we think the promo and marketing environment is much more tame this year than last year, which means DraftKings will be closer to that profitability level, all important level of profitability, which we think is going to come maybe even sooner than people think. And the reason we think that the promotional environment is more tame, because there are very few new states this year versus last year. And new states, you have customer acquisition costs, so everyone's scrambling to acquire those customers. Well, without those new states, you're relying on same state activity, which tends to be much less promotional, much less marketing as well. Also, there's fewer market participants overall and fewer or zero new market participants like there were last year. And that always heightens competition, right? Caesars and Wynn already announced that they're spending less this football season. And Penn's going to report actually on Thursday, so a day ahead of DraftKings. And we think Penn, with their Barstool commentary, is going to talk about a less promotional environment as well. So that should be a good catalyst even before DraftKings reports. And then finally, I mentioned net revenues before, and the key here is that this is another catalyst. Now DraftKings should grow its net revenue share faster than handle, and that's more important. And what's happened is DraftKings has lagged in terms of hold percentage. Hold percentage is the percentage that the casino or the operator keeps, and that's because they've lagged in parlays. Well, they're making inroads there, and you're going to see that hold percentage tick up and get closer to industry average. And as you can see from this slide, if they get to industry average, that means revenues are 30% higher and EBITDA. I'm sorry, revenues are 24% higher and EBITDA is 30% higher. So with these catalysts in mind, a depressed stock, I think there's a lot of upside, and it could come real soon.
I got something tasty for you that's new. The trend signal for DraftKings just went to bullish trend for the first time. And for the record, Hedgeye bearish, Todd Jordan bearish on DraftKings from like $70. Okay, they went from 70 to his point to the lows. As long as it stays above 1486, the way to read that is it's what we call a bearish to bullish trend reversal. And it's got upside on a squeeze, TJ, like towards 2021, like in a day. So that's an interesting trade. I guess that's the quick question. Beyond 21, are you still a buyer?
Yeah, probably not. That's sort of our price range too. It's like $20 to $22 is where we think this thing can go really quickly. So I'm happy to hear that's matching up with your model.
Yeah, I mean, it's totally different than Microsoft. Microsoft is like passive nightmare. Vanguard does own 5% of DraftKings, but so does ARK, who's the active one. And some people go, well, whatever you had feelings, I don't do feelings. Let's go to Tom Tobin. Tom, you and I have been working on our feelings for a long time.
Yeah, fade your feelings, body language, data. Keep it simple. I'll try to get through this. So I'm gonna pitch you HCA on the long side.
Nice. We got more longs and shorts all of a sudden here. This is getting
good. I was here with 10x the last time, and that's been a short.
TXG. That's been a beauty.
It keeps on giving me, but with 9 slides here. So the first is a ton of pent-up demand. So what you're looking at in this first slide is essentially the cumulative difference between trend and actual for hospital care. I've repeated this slide multiple times across all different types of care. There's a lot of medical care that has not been delivered. People have gotten sicker over time. They're showing up now much sicker than before. But elective procedures is the biggest part of that. So things that could be deferred or delayed, have been. and have continued, even as COVID is ending, but we're getting to that point where it's starting to come back. The rate limiting step has been wages and scarcity of labor, particularly acute in healthcare. I think we're reaching the end of that on the next slide. I think we're going to have these scarcities around, but I think the operators are learning how to live with it. Wage inflation has been high, but I think it's ebbing. The comps are getting, from a wage inflation perspective, and what we're measuring here is salaries, wages, and benefits on an adjusted patient day basis. The Omicron jacked rates really high Q1. The toughest comp was Q2. Q3, you're starting to see that come off. So 7% went to 3% sequentially. When we ask macro, you say, okay, well, what's some healthcare macro data? Those are the highest correlating series. If we use those underlying data sets on slide 3 to build a forecast model, so we're looking for we're limiting the error on the forward estimate, combining and recombining healthcare macro data. It basically says the same thing. Things are slowing. We'll keep updating this, as particularly on a week like this, where we're getting ADP, the BLS numbers, PCE, a bunch of other stuff. Basically, the trend line here for us is that Delta and Omicron we're getting into the comp. We're gonna have easy comps on volume. Wages are slowing. That should be a good margin setup. On the next slide, the kicker here, I think, and what makes this interesting, more so heading into fourth quarter, is the flu season is gonna taking off at a pretty rapid pace. Care Now is it's about 180 clinics that HCA owns. It's a feeder for the hospitals. They have a telemedicine part of that. So you're gonna have a lot of flu vaccinations, a lot of sick visits. The volume should be quite good for the outpatient side. I also think people are going to be coming in and getting that thing that they didn't get checked out, to get it checked out. So on elective procedures on the next slide, most of the profitability comes from these elective surgical procedures. You can see that on the right-hand side. There's a sample on the left-hand side. If you read that, you would see that it's anywhere from $9,000 to $60,000 per case. You could come up with a margin in the mid-teens to 20s. Anecdotally, on the margin on the incremental, it's 20, 30, 40, 50% in terms of what drops through. Some hospital CFOs have told us it's even higher. So again, when this stuff comes back, you're going to see a margin boost. For HCA on the next slide, this is there. Again, this is the deferral care. This is what trend was. This is what the cumulative total is on the left-hand side. On the right-hand side, I put that margin to that volume. I think there's about $900 million sitting on the sidelines. That compares to about $12.5 billion currently for 2023 EBITDA. It's probably a lot higher than that. So I think I have a good basis for thinking that there's incremental margin coming back. The street has down margins for next year. I think they're actually going to be up. So there's a lot of ways to win here heading into next year. And again, in the shorter term, I think we get easy comps on volume, easy comps on wages with a flu kicker. The P&L, in terms of how I've walked this down in terms of what the impact is, you can see in the bottom line on the slide 7, or on your next slide, is just what that incremental. It's basically looking for, like, what would you need in terms of surgical volume to replace COVID? Somewhere in the low to mid single digits. Again, there's $900 million. Like, what do we need to get to fill the COVID hole, and then think about what's after that? Yeah,
that's good.
The last two things is we've already been through the revision cycle on the second to last slide, and then what's it worth? I think you get the stock up into the high 200s on the last slide. The quad factor setup is actually really positive as well. The factor setup is a 53% batting average, 60 bips weekly, and it has a sample size for that setup about 17% across all prior quad 4s. So it should be a very stable, big cap, high margin, profitable name that sits in it for a defensive quad 4 name. That's it.
Nice. It is also bullish trend. So good news is that we have 2 to the 3 are bullish trends. Domino's is not, but Domino's is bullish trade. But trend, and I'd use that as a stop on anything. That's what my stop is. Just commentary quickly here on that. 207 is trend for HCA, so it's above that. It came down from 270, so that's where Tom's saying it could go back to. Risk range is 205 to 230 on the immediate term. It's got the factor exposures you want. It's got large cap, $62 billion in cap, low beta, large cap. That works in quad 4. So again, not all things are bearish in quad 4. Unless you're Andrew Freedman and you have to deal with all of his stocks.
Yeah, I know. The communication space has been tough.
Well, T-Mobile has been a good sign. I mean,
T-Mobile's been great. Yeah, thank God. We're pitching Live Nation on the short side.
Yep. There's no economic cyclicality to it.
I got a few slides in here that I think you'll like. Four key thesis points. On point one, which is the foundation of our as good as it gets call, we think the timing of events going on sale, ramped aggressively into reopening and is now hitting a peak in rate of change terms in the second half of this year, which remember, this is a supply-driven industry. Live Nation ramped up supply significantly above 2019 levels in order to capture that pent-up demand, which was the right decision to do, but on the back end, obviously, that we think that's going to hurt them more than what's currently reflected in consensus numbers. And again, all that demand occurred in a compressed period of time, just given the timing of reopening, which we think mean reverts and has the high potential to go negative over the next kind of 12 to 18 month period, while the street's modeling a slowing growth, but still growth nonetheless, largely back to previous trend, which we think they'll overshoot to the downside. So if we're right on point one, then point number two is going to follow, in that per cap spend mean reverts and possibly goes negative, which is their highest margin spend, which will weigh on their adjusted operating income, especially if we factor in an increasingly weaker consumer, given quad four. I'll skip point three and just go right to point four, which I already alluded to this, but I think it manifests itself through the fundamentals, through flat to down AOI growth this time next year going into 24, which I know it sounds like a lifetime away, but I think we start to see weakness emerge in some of the leading indicators beginning with this quarter in the Ticketmaster business as trends normalize, and with cyclicals, I learned this from the great Jay Van Sciver, you want to be early because by the time the thesis plays out in the fundamentals, it's likely already too late in the stock. So just to kind of prove some of these key thesis points, some commentary directly from the 10Q, just talking about what the timing of the recovery. When they report earnings this week, this will be the first quarter that we see that's actually a full quarter comparison. Management, this is a management team that's very promotional. They're in the business of promoting. They're very good at promoting their stock. When we're going into reopening, they couldn't say pent-up demand enough. And now all of a sudden, here we are, we're about to lap that pent-up demand, and now they're starting to backtrack a little bit, saying, well, it's not really pent-up demand. In terms of the data that we're tracking, in terms of the events that are going on sale, you can clearly see the ramp that I was referring to. And we're not seeing, in terms of the total events go on sale, significant acceleration. It's more of a getting back to 2019 levels of number of events and flatlining there, which I don't think is good for the Ticketmaster business specifically. And then when we think about the comp dynamics in terms of where events were scheduled, we do have to remember that when we're tracking rescheduled events on the next slide, that because of usually the summer period, June, July is peak season for festivals and a lot of concerts, but because things got pushed back, given the pacing of vaccinations last year, things did get pushed back more so later into the summer, early fall, which again, if we assume that trends will normalize, go back to 2019 levels, that makes for a pretty difficult comparison. And Keith, these are just some anecdotes for you, which I thought you would like. So what did this management team say in 2007 and 2008? Doesn't seem to be any data that would suggest an economic downturn has any effect. Then what did they say at the end of 2010? Concert attendance decreased 16%, and for 9 months it was down 10%. And why? It's because the consumer didn't show up. And what are they saying today? This is an industry that's been fairly recession-proof. And this is what the data looks like in terms of what happened in 2008, 2009, showing when we go all the way back through the filings, Ticketmaster tickets sold declined, followed by a decline in concert attendance. I don't know. It's an analog. It's interesting. I think it happens again. And this is one I think we'll stick with for a while here, at least until it plays out through the numbers. But that's Live Nation.
Live Nation. Now, let me show you a screen here from my friend. I look up, Michael Rapino is from my hometown, Thunder Bay, Ontario, the pride of Thunder Bay. Now, where I come from, you see these? Rapino. $18.4 million insider sale. Woo! 2.6, 2.6, 21.2, 21.4 million.
That's a lot. That's a chunk of change.
Now that's a smart guy from Thunder Bay.
There we go.
That's a smart guy from Thunder Bay. In the business, again, great job at the company, but in the business of selling stock, he knows. Mm-hmm. Promoting stock, selling stock, that's what, promoting concerts. People, don't confuse what you see on TV or at concerts with what you're going to get in the real world. Watch those insider sellers, okay? Set up, by the way, bearish trend on Live Nation, 92. It would have to get above that, and doesn't look like it has hope and help doing that. Risk range 75 to 82. Medium term downside to 75, that means. And again, it's pre-pandemic high was 76, and prior to that, it is what it is. Prior to the pandemic, we would not have a Chinese guy standing beside me in a row. All right, so you're still in your own pandemic. Chinese stocks.
Yeah, it's been tough, but I'm in my robe again and pitching another long today, Keith. EDU.
You are.
EDU, so New Oriental is my number 2 best long idea. You know, the education industry has been rocked by the suffocating double reduction policy last year. So this year, everyone is looking to reorganize, transform, and survive. And for EDU, you know, there are a couple catalysts out there, the main one being live streaming. So now it's unbelievable that an education company is turning into an e-commerce company. So let's look at one slide here on the next slide. So EDU's live streaming arm is called Oriental Selection, and they have 3 different shows in terms of content. And the star behind it is a guy named Michael Dong. But Dong's teammates are also excellent hosts. So in live streaming, in my opinion, it's all about likable hosts, quality products, and an effective supply chain behind it. Oriental Selection is working on all 3, and they started selling agricultural products, but now they're much more diversified and even selling beauty products. Oriental Selection is the number 1 live streaming platform on Douyin. Douyin is otherwise known as China's TikTok in terms of traffic and GMV for 4 consecutive months. That is a huge accomplishment for a live streaming platform that just barely debuted 4 months ago. I track Oriental Selection GMV on a daily basis, and it's been straight line up for 4 months since June. And while Oriental Selection is mainly selling on the Douyin platform, they've also set up rooms in other platforms like Taobao and social e-commerce players Xiaohongshu. So more growth opportunities there. So on the next slide, you know, as a result of Oriental Selection's success, I estimate EDU's revenue contribution from their online arm, Koolearn, will grow from 4% in fiscal year 2022 to 28% in this fiscal year 2023. That's higher than what the management's guiding of 20% contribution. Keep in mind that EDU's fiscal year ends in May. So that's a little bit on the next slide about EDU's new live streaming opportunity. Another catalyst for EDU is with their core business, particularly on the overseas segment. So when I shorted EDU in second half of 2020, it was predicated on weak overseas demand, driven partially by Trump's policies and also the long-term demographic headwinds. Well, that has played out for the last 2 years, and recovery is now well underway. It's well noting that in the past 10 years, there's only been 1 year where there's growth for kids aged 15 to 17 in China. And that's this year, 2022. So I anticipate interest in overseas test prep to grow for at least 1 to 2 years as these kids age. I also think, you know, double-digit growth in overseas is sustainable for EDU, particularly as China slowly eases international travel restrictions, which will make overseas education much more attractive. In other words, in the next few years should mirror what EDU did in fiscal year 2018 and 2019, and that's despite China not completely open up yet. And finally, let me address valuation on the next slide. So based on my analysis that I wrote to clients, you know, the market is placing zero value on EDU's core businesses outside of overseas travel. So that includes their high school content, their adult university education, and more importantly, their new businesses in non-academic tutoring and smart learning devices. Zero value. Enough said on EDU being undervalued.
And people in the U.S. that have FOMO for their stocks, like how you doing today with Amazon? How you doing with these stocks? This man knows a bear market. This stock went from 200 to wherever it is, and it's at 25 today, with zero value being assigned to core parts of it. Now that's a bear market, okay? It takes time to play out. By the way, it just got back above trend, 23.98,
Good.
So that's good. It's got a hold there. The problem is that it's got a range of $19 by 29. You could drive a truck through it. So you got some. So you're saying there's a chance. Quick question: Liberty Media, do they own 41% of this?
No.
There's somebody. It says Liberty Media's got a massive holding in themselves.
No.
No.
Must be another company.
Yeah, something.
The biggest ownership is the CEO.
Oh, okay.
Yeah.
Okay.
Unless I'm mistaken, I've never heard of Liberty Media.
He should get you on the EDU channel with that robe. You look good, man.
Trying to get some new ropes.
All right, now you're going to get replaced by the one and only Honey Badger. That's your new nickname. You good with that?
I'm good with it. It was given to me, so who am I to turn down?
Last night, Simone was wearing that hat.
Yep.
With what on it, underneath it?
Oh yeah, so my wife got on me last minute, asked me what my Halloween costume was, and I didn't have one, so I put a bag over my head and did the old unhappy face bag with the Yankee cap attached to the top.
Well done.
So listen, when we get our asses kicked, and then when I'm wrong, I'll admit when I'm wrong. I'm actually going to talk about a little place where I'm wrong on this one. So
okay, go for it.
All right, so I'm taking a little break from MPW. Don't worry, I'll be back in Dallas. Like you guys will get a treat on MPW, but not right now. So I'm going to talk about the invitation short. and slight mea culpa, yesterday I actually updated my numbers a little bit. I was a little too draconian on their property tax expense, and I had a very interesting, back and forth with clients and with some folks at home as well on why it was wrong, and you guys were right. So I adjusted my numbers, but the point remains, and that is that numbers are just way too high for next year. So if just kind of rewinding the clock a little bit, we initially put invitation on the short side when there was a whistleblower case filed in the Superior Court of San Diego earlier this year that I thought was pretty serious, and I still think is pretty serious, but was not being discounted by either the buy or sell side. But what's really interesting is since then, and we talk about this all the time around here, the fundamental backdrop has weakened, and I think has weakened in a big way for this non-cycle tested business. The SFR industry was born out of the great financial crisis. It's been a beneficiary of an extremely tight housing market and tightening housing market over the last decade, but also low interest rates. And you could probably put this one into the bucket of companies, especially among REITs, that may not work under a different cost of capital framework. But stepping back from that a little bit, this company is going to grow same-store revenue in the low double digits this year. Call it like 12 to 13%. There is a huge decel coming next year, and while people acknowledge that there is a decel, they do not acknowledge the degree. And I laid out a simple build-up here. If you think about same-store revenue for an apartment REIT, an SFR REIT, it's really a function of occupancy, of rate, with an offset being bad debt. And now, obviously, like Keith would, probably, or definitely, vouch for, agree with this. We're probably the most bearish out there on the economy in general and the consumer specifically. Bad debt is going to go up, and it's my contention that when we came into the year, bad debt was obviously a tailwind for this business. It's about to become a headwind. I'm modeling in my numbers a return to bad debt as a percentage of revenue back to pandemic levels, in addition to some slight, not even like, I actually think I'm pretty generous on occupancy. I think these guys are going to revert pretty hard to like kind of more traditional occupancy levels. And when you combine that with this kind of fugazi concept of earn-in, which I'm not even going to go off on my tangent on that. You combine that with like a reasonable estimate of rate increase, you're talking about something like 3.5% to 4% revenue growth, whereas the street's at 7%. Higher property taxes, higher turnover, and higher R&M expense are probably going to drive high single-digit expense growth. So if you have 4%, or 3.5% to 4% top line, and 7% to 8% expense growth, there's no way that you're going to grow same-store NOI at 7.5%, and that's where the street is. So numbers are too high; they need to come down. Second point, I've been thinking a lot in my space about uses and sources of funds. And when I say that, I mean that, like, if you look at the shareholder list, and I actually have that on a later page, we'll go to it really quickly in a second. Invitation is over-owned. Actually, this slide right here. Yeah, we can go to that slide, and I'll keep talking through it. Invitation is owned by some of the largest REIT-dedicated accounts out there, right? So it's a consensus long over-owned name. no one has been shifting their ownership. As a matter of fact, they've been adding to positions into a rate of change slowdown. And at the same time, there's not a single sell-sider that has a sell on the stock, and they're way too high on numbers. So you have this like kind of insidious brew of declining rate of change, or deteriorating second derivative, an overowned name on the buy side, and numbers that need to come down on the sell side. And then lastly, obviously, last point, the whistleblower case is a tail risk hanging out there, and we'll probably get resolution on that over the next 3 to 6 months, and that's the pitch.
Whistleblowers, I tell you. Okay, just pre-pandemic, this thing, I like to look at these things like, where were you in the best of times before the pandemic? $31. That's as good as this got.
Yep.
Cohen and Steers owns 15% of the stock.
That's
Norges
right.
Bank owns 7%. These are massive positions. And only 4% short interest after everything that's happened.
Yes.
Even if you're wrong on everything and I was just right on the economy, this thing would be a short.
Yep.
I mean, it's like a
Source of funds. It's a source of funds. Like that's like the whole concept. Like when these guys have to pivot to longer duration, capital's coming out of names like this, I think.
All right, just to round this off, and by the way, no insider buyers. Okay, they call us everything, but we'll call you no insider buying. That's what we'll say back. And 37's trend, so it would have to get above that. The setup is 29 to 33 on the risk range, so downside. This is very immediate term. Longer term, obviously, Rob's talking about a lot more downside than that. Daniel, if you don't have a long, I will be surprised.
Okay.
Your world has longs.
Right.
Staples.
I do have another long, and thanks for having me back. I'm looking to go 2 for 2 now.
Good, good.
So I got a long for you. It's called BJ's, ticker BJ.
A BJ Wholesale.
Yes. Quad 4 is BJ's time to shine. Since returning to the public markets in 2018, BJ's has really changed a lot. So it's deleveraged from 5 times to less than 1 time, and it has doubled the store growth rate. So really looking to ramp that growth rate up. So BJ's offers members a compelling value proposition in a time of challenging inflationary pressures. BJ's prices are lower than mass merchants and 25% less than supermarkets. And the environment that we're living in right now is a tailwind for BJ's, right? So food inflation, elevated gas prices, tighter household budgets, who knows how we're going to heat our homes this winter, right? They're all pushing people to find ways to get more food for less. So my estimates are higher than consensus, and this is a beat and raise story. On slide 67, you can see that BJ's just enjoys Quad 4. I don't know if you have any other chart here today, Keith, that looks as good in Quad 4 as BJ's.
No.
This one's a pretty Quad 4 chart. On slide 68, this is BJ's store map. BJ's is an East Coast club chain. So this is, it's slowly making its way westward. It has a long way to go. So we can track the traffic at the new stores, and they're opening generally in the middle of its entire store range. And that's pretty important because club stores take a lot of time to mature. This isn't like where anyone can just walk in, right? Like you have to pay to be a member, so how are you supposed to know about this? So the fact that they're finding new stores and they can double their growth rate now, it says a lot, right? So when someone has to pay to go to the store and how are you supposed to know about it, that's a good sign for their future growth rates going forward and its westward expansion. So also going forward on slide 69, so what BJ's is its strategy is to compete against traditional supermarkets by making fewer warehouse club changes to the business model. So they offer more SKUs than the other club chains, and they offer mainstream brands, and they also offer it in smaller club sizes. So they're looking really to compete against the supermarkets than the other club chains. And they also take coupons, just like you're used to the grocery store. So this is a very easy sort of switch right now in this time of high inflation to switch from a grocery chain to a club store. The merchandise mix is 83% groceries and only 17% general merchandise. You can see who they're really trying to compete against. They're really not trying to go against like a Walmart. 70% of the locations that have an adjacent or nearby gas station that they own, right? So they're offering it almost at cost, and that offers a compelling value or trip consolidation, right? That's how they're driving traffic. With the gas prices the way they are, it's an advantage for them. And then slide 70, you can see here that since the pandemic, twice as many people shop for groceries, primarily at club chains, than they have been before, right? People have switched and how they need to save money, and they're going to the club stores. And there's sort of a commitment for that membership fee. And finally, on slide 71, you can see that membership fee income is 57% of EBITs, right? So more than half of their profits come from this membership fee, which is so much visibility. I mean, we're talking about like real estate utility type visibility into their earnings, right? And this membership growth has been accelerating with the westward expansion and with the environment that we're in. So I have BJ's as a long for you.
That's the. It's hard to find a stock chart too that looks like this. I mean, and most people say, "Oh, I missed it." No, actually, the whole point about the game is to stay with winners, ride them, and get rid of your losers. Most people that are listening to this have struggled doing it the other way around, and that would include me. Take some time, right? Sell your losers, ride your winners. BJ's been a winner. Its bullish trend with 72 would have to break down through 72. It's at 78. It's up again today. It's signaling higher highs and higher lows, which is very bullish in the risk range, 74 to 81. And again, find me stocks that are making new highs on the right fundamentals, not just getting squeezed because hedge funds are shorted. In fact, this one's only got 3% short interest.
Pretty small.
And you don't have any real large hedge funds that are long it. There's no page one holders.
Yeah.
So it's interesting.
They really missed it. They doubled their ownership in Q2 from 5 to 10%, I think. But they really haven't participated in the rest of the rally. So there's still a lot of reluctant people watching this one. And I think it's they just made me think it's too mainstream. I think a lot of it will just be getting more awareness for the story. It's not that well known, right?
Well, the other thing too is Wall Street, and I'll just go to Van Sciver next. If Wall Street doesn't shop there, I used to shop at BJ's when I had no dough. I mean, you'd have to go in there with as much cash as you can, get as much as you can. I mean, that's how people that are, and a lot of Americans are under that kind of pressure. So it's an interesting one.
I agree. I think one of the things about it is it lives in the shadow of Costco. Everybody wants to compare it to Costco, but if Costco didn't live there, I think the multiple would be much higher because everyone just compares it to Costco, but it's not Costco. Compare it to the grocery stores and you want to own it.
Maybe it will be. He's been a ninja this year, and he doesn't look like a ninja. He's just been like a ninja. Yeah, Daniel Biolsi. Thank you. All right, Jay Van Sciver, what's up?
Hey, I think wasn't he the CIA guy though? That was a pretty good early look, if I remember correctly.
Yeah, he was.
Close enough. So we're pitching VW as a long, and I say that in part with the hesitation that it makes an exceptional long pair against a lot of our auto-related shorts. So we have a bunch of auto shorts, and this I think is one of the most interesting names that I cover because it is in fact just mispriced, right? It is what we all are theoretically looking for in capital markets, a security that is trading at the wrong price. Not quite an arbitrage, but it is reasonably close to that, given that its size and complexity, I think, has dissuaded investors from looking at the basic, very simple fact that you have a Porsche AG, Porsche P911, which is trading publicly for more than what its owner, VW, which owns 75% of it and has the cash from the rest of the sale, is trading for. So you actually have like an incredibly obvious sum of the parts story in a liquid security and a situation where VW can actually sell more. So we have sort of the top three things. You'll see, basically it is trading at an unwarranted discount to its parts. It's not even close. I mean, just Porsche is, whatever, 11% of sales, and it's trading for more than what all of VW is trading for. Second, auto sales are already down, right? So even when we look at our short side in autos, they tend to be things that relate to used cars like Abe's Budget, or they relate to things like, profitless or low quality auto names like Lucid. Tesla, I will put in that case of low quality, and I will argue that until I'm in the grave. This is a great long pair to that. And then even within VW, like making the point even more obvious, we have VW preferreds trading at a discount to the common. The only difference between the preferred and the common is your vote, and your vote doesn't matter. So there's really absolutely no reason for the common to trade any different from the preferred. And historically, they've traded exactly the same sort of ratio. So if we look at just sort of auto sales, you can see they're already down. So we're already at financial crisis levels of auto sales. As Josh was talking about in the morning call, we're starting to see shipments rebound. That's bad for used prices, but that's pretty good if you're selling cars and you haven't been able to make what you sell, right? You're finally going to get your revenues back up a little bit. And even if demand goes down a bit, you're already selling at a level that's so low, it's kind of already a headwind. You're already at trough-ish like levels of sales. Secondly, there's pent-up demand, 78. You can see the age of used vehicles there. They're pretty old. Had sales below replacement demand, consistent with that thesis. Within VW, you have a lot of very good franchises, but we also have an example of a very similar thing that played out where a traditional, in this case it was Fiat, which is now part of Stellantis, spun out or sold off, IPO'd Ferrari. Again, you had a family that was in control instead of the Porsche family. You had the Agnelli family, and it created a huge amount of value for shareholders. And I think Ferrari is a very significant, comparable success story to what's happening at VW. And the analogies are obvious. In terms of the sort of electric vehicle premium, VW is obviously a leader within electric vehicles, with the Taycan usually considered, at least last year, the best EV you could buy. And when we do surveys, Audi actually surveys better than Tesla as an EV manufacturer, and they're building a charging network that's going to be comparable. Some of the parts, it's a double, right? It's actually a little better than a double. And that's just sort of against mostly cash, the book value of a finance subsidiary, and a publicly traded liquid security in Porsche AG. So we have pretty good visibility into some of this stuff. You can argue with the little stuff. I don't care. You just need the big stuff to play out. You can see here the discount of the preferred, which is a common, which is, I think, noticeable. So you get something that's trading for less than what is publicly traded and out there. You're getting into a depressed cyclical, and you compare it nicely against either its own common or a bunch of low-quality auto OEMs.
Well done. Thank you. All right, I'm going to end it with my favorite on the short side. Not only is it my favorite, but it's Jay's favorite on the short side of that one, which is Tesla. Medium-term downside on Tesla to 202 from here. I mean, what could possibly go wrong? You got the mother of all bubbles sitting right there, right in the face. Again, the concentric bubbles, there's so many bubbles, from Dogecoin to Elon, pitching it to whatever. You want to be long EVs, you just got to pick on the other side of that. Last thing I'll say, in addition to that, obviously Tesla's been a short for us for quite a while here this year after being a long last year. Don't forget that many of our shorts are our former longs, and our former longs are our former shorts. We encourage you to think that way. It's a better way. We like to go both ways, and we're proud of it. So that's a real important thing, whether you're buying calls or you're buying puts. It's okay. You can do this. Again, just getting pitched a bunch of stocks, perma-bulls on the long side when people are trying to sell into you, there's always a sucker at the table, and it better not be you. All right? So again, 10 different ideas. I thought we were going to have more shorts. I thought wrong. I think wrong lots, okay? 6 longs, 4 shorts. Great job by my team. Thanks for joining us.